Hi there, and welcome to our financial tutorial on basis risk. Today, we'll dive deep into what basis risk is, why it matters, and how it can be managed effectively. Whether you're an investor, trader, or risk manager, understanding basis risk is crucial for your financial decision-making process. Basis risk is the risk that the price of a futures contract will not move in normal, steady correlation with the price of the underlying asset. In simple terms, it's the risk arising from the imperfect correlation between a hedging instrument and the underlying asset being hedged. Let's take an example. Imagine you are a wheat farmer. To protect yourself from the volatility of wheat prices, you decide to use futures contracts. You sell wheat futures to lock in the price at which you will sell your harvest. Now, the difference between the spot price of wheat, the current market price, and the futures price when you sell your harvest is called the basis. In a perfect world, the futures price and the spot price move systematically, resulting in a predictable basis. However, factors such as supply-demand imbalances, market sentiment, and external economic events can cause deviations, leading to basis risk. Consider an example where the spot price of wheat is currently $500 per ton, and the futures contract is trading at $520 per ton. The basis, in this case, would be minus $20. At harvest time, the spot price drops to $480 per ton, while the futures price is now $490 per ton. The basis has now changed to minus $10. This change in basis could affect the farmer's hedging strategy and eventual revenue. So, why does basis risk matter? If the basis widens or narrows unexpectedly, it can lead to either a gain or loss for the hedge position. Properly managing basis risk is crucial to ensure that hedges protect the intended value. Now, let's talk about how to manage basis risk effectively. The first strategy is diversification. By spreading investments across multiple assets or futures contracts, you can mitigate the impact of basis fluctuations on a single asset. For instance, an energy company might hedge its exposure not just in crude oil, but also in natural gas and coal, as price movements in these commodities may not be perfectly correlated. Diversification helps in spreading out the risk. For instance, if a company deals primarily in jet fuel, but there are no suitable futures contracts for jet fuel, it might use heating oil futures instead, due to their high correlation. One question you might have is, how can I measure and monitor basis risk? Common methods include historical analysis and basis tracking models, which analyze past basis movements to predict future behavior. Historically, by tracking the regular fluctuations in basis over a given period, you can build a model to predict potential future basis changes. Many risk management software tools offer features to track and predict basis risk. We also need to stress the importance of stress testing in basis risk management. Stress testing involves creating hypothetical adverse market scenarios to assess how the basis might behave under extraordinary conditions. For example, if you are managing a portfolio of commodity futures, you might consider scenarios such as extreme weather events, geopolitical tensions, or global pandemics, and their potential impact on the basis. Let's summarize with some key takeaways. Basis risk is an inherent part of any hedging strategy and can't be entirely eliminated, but can be managed through diversification, cross-hedging, historical analysis, and stress testing. To further illustrate the concept, let's tackle a few common questions. First, can changes in interest rates affect basis risk? The answer is yes. Changes in interest rates can influence futures prices differently than spot prices, thereby affecting the basis. Another question often asked is, does the quality or specification difference between the hedged asset and the futures contract contribute to basis risk? Absolutely. Quality or specification differences can cause basis risk, as the futures price may not perfectly align with the spot price of the specific asset being hedged. As we wrap up, remember that while basis risk is complex, understanding it can significantly enhance your hedging strategies and overall financial performance. By carefully managing this risk through various techniques, you can protect your investments more effectively. thank you for joining us in this comprehensive guide on basis risk. If you found this tutorial helpful, don't forget to like, share, and subscribe. Leave your questions in the comments below, and we'll try to get back to you as soon as possible. Until next time, happy investing!